Have you ever wondered how some traders consistently identify winning opportunities while others struggle to break even? The secret often lies in technical analysis, a powerful tool that helps you read the market and make informed decisions. In this guide, we'll break down how you can use technical analysis to maximize your trading profits. Whether you're new to trading or looking to sharpen your skills, this video is packed with actionable tips to take your trading game to the next level. Let's dive in. What is technical analysis? Technical analysis involves studying historical price movements and market data to predict future price behavior. Key components of technical analysis: charts, visual representations of price movements; indicators, tools that provide insights into market trends and momentum; patterns, recognizable formations on charts that indicate potential price movements. Why it matters. Unlike fundamental analysis, which focuses on the underlying value of an asset, technical analysis helps traders understand market psychology and timing. Step 1. Learn to read price charts. Understanding charts is the foundation of technical analysis. Types of charts: line chart, simplified view of price over time. Bar chart shows open, high, low, and close OHLC prices. Candlestick chart, popular among traders for its detailed information and visual appeal. How to read candlestick charts. A green or white candle means the price closed higher than it opened. A red or black candle means the price closed lower than it opened. Wicks, shadows, show the high and low prices during the period. Step 2. Use key indicators. Indicators help you analyze price movements and identify trading opportunities. Here are a few essential ones. Moving averages, MA, shows the average price over a specific period, helps identify trends. If the price is above the MA, it's an uptrend. If the price is below the MA, it's a downtrend. Relative Strength Index, RSI, measures momentum and identifies overbought or oversold conditions. RSI above 70, overbought, price might drop. RSI below 30, oversold, price might rise. Bollinger Bands helps identify price volatility. If the price touches the upper band, it may reverse downward. If the price touches the lower band, it may reverse upward. MACD, Moving Average Convergence Divergence, shows the relationship between two moving averages. Positive crossover, MACD line crosses above the signal line. Buy signal. Negative crossover, MACD line crosses below the signal line. Sell signal. Step 3. Recognize chart patterns. Patterns can signal potential price movements. Trend reversal patterns, head and shoulders, indicates a reversal from an uptrend to a downtrend. Double top, double bottom, signals a reversal in price direction. Continuation patterns, triangles, ascending, descending, symmetrical, suggest the trend will continue after consolidation. Flags and pennants indicate brief pauses in a trend before continuation. Candlestick patterns, doji, indicates indecision in the market. Hammer signals a potential reversal to the upside. Shooting star signals a potential reversal to the downside. Step 4. Understand support and resistance. Support and resistance levels act as barriers to price movements. Support, a price level where the asset tends to stop falling and may bounce back. Resistance, a price level where the asset tends to stop rising and may pull back. How to identify them. Look for areas where the price has reversed multiple times in the past. Use horizontal lines or trend lines to mark these levels on your chart. Pro tip: when a resistance level is broken, it often becomes a new support level and vice versa. Step 5. Combine multiple tools for confirmation. No single indicator or pattern is 100% reliable. Combine tools for greater accuracy. Example: use RSI to identify an oversold condition. Check if the price is near a support level. Look for a bullish candlestick pattern, e.g. the hammer. If all align, it may indicate a good buying opportunity. Step 6. Manage risk effectively. Even with technical analysis, trading involves risk. Protect your capital with these tips. Set stop-loss orders. Limit your losses by setting a predefined exit point. Use proper position sizing. Never risk more than 1 to 2% of your account on a single trade. Follow the risk-to-reward ratio. Aim for at least a 1-2 risk-to-reward ratio. Risk $1 to gain $2. Step 7. Practice, practice, practice. Before trading real money, practice with a demo account. This allows you to test your strategies, gain confidence, Understand how technical analysis works in live markets. Technical analysis is a powerful tool that can help you maximize your trading profits. Question for you. Which technical analysis tool do you find most intriguing? Let me know in the comments below.